All right. Hi, everybody. Welcome to an episode of Money Monday that is happening on Wednesday of all times. Why? Because of the Facebook outage that happened on Monday. Today we're going to be talking a little bit about that, and we're going to be talking. Ooh, it just blinked at me. Oh man, I thought I was live before. I guess I'm live now. I've been talking for like a solid minute. Okay. Hi, everybody. Welcome to another episode of Money Monday on Wednesday. I'm Henry. I'm your friend in finance. We weren't able to make it have a presentation on Monday because, as you might have experienced, there was an outage, a Facebook outage on Monday. And today we're going to be talking about that. We're going to be talking about why that Facebook outage happened and how a solid financial advisor could have actually kept Facebook from having that same outage, and how you can apply that same wisdom in your life to keep you more protected. Real quick before I do that, give me 1 second because I'm going to share this on my personal Facebook page now that we are in fact live. And as I'm going ahead and sharing this, one other thing that I want, a couple other things that I want you to bear in mind. We got some great things coming up. For instance, at the end of the month, on October 27th, we have our Real Estate 101 Home Ownership webinar coming up again. This is a old favorite. We did this last year. We're bringing it back. People loved it last year, and that's why this topic just hasn't gone away. If anything, the housing market has gotten crazier, and so we want to talk to people about exactly what role their house has in their overall financial picture. It's totally free. If you're thinking of buying a home, if you're thinking of refinancing, or if you just want to know how exactly is this house or this mortgage, how does that play into how does that compare with investments? Like, what am I supposed to be doing with my money? Is a house the right place, the right thing to do? Come to this webinar. We'll show you exactly how real estate, whether it's your house or investment properties, how they fit into your overall financial picture. Also, if you are a client, we got our book club coming up at the end of the month too, starting October 20th. We're going to be reading Psychology of Money. I thought I was pulling out the right book. I thought I had it right here, but I do. Oh, there it is. Give me 1 second. A couple things aside. We're going to be reading Psychology of Money by Morgan Housel. A couple people already started reading it, and they've told me that they've gotten pretty far because it's a pretty easy read. Amazing book. It's 19 short stories with different financial lessons for everybody. A really easy read too. So that's good. If you're a client, that's coming up on October 20th. I hope you'll take part. And we won't have a Money Monday next week because we're going to have our monthly mastermind. So if you're a client, check your inboxes because we've sent out some invites to the monthly mastermind coming up. Love to see you all there. It's always a pleasure to see all of our clients. Now, let's talk about what happened on Monday to Facebook. Why did Facebook go down, and specifically, why did it go down for hours on end? The answer is because Facebook runs everything from Facebook. So when Facebook started having some issues, their whole platform, they had a brief issue. The way that I understand it is they had an issue where some code was accidentally sent, allegedly accidentally sent, presumably accidentally, which to the way that the internet runs is there's different like nodes that tell us, oh, if we're looking for Facebook, then it directs us to the right server. One of those servers, those nodes ended up getting instructions code that basically said the Facebook server doesn't exist, which normally wouldn't be a problem, except that Facebook runs everything from Facebook. So normally what would happen is that the webmaster or the admin, the IT person at Facebook would just go send another code going, just kidding, come on down, we're still open for business, and then the nodes would know to start directing people correctly. But because Facebook runs everything from Facebook, what ended up happening was that they couldn't access the code to send the correcting code, which ended up causing ripple effect. They couldn't even get into their offices to unlock the servers or contact the person who had the key to get into the offices because, again, they ran everything through Facebook because they've drank the Kool-Aid. I mean, they're creating Facebook, so it makes sense that they're drinking Kool-Aid. But because of that, when one part of their system, when their servers went down, when they weren't able to contact the servers, suddenly that caused a huge ripple effect, and they weren't even able to fix it. do you see? Are you starting to see what the problem is? They put all of their eggs in one basket. And you might have seen in the description, a solid financial advisor would have been able to step in and go, hey, you got a problem here. This isn't the way that it should be set up. We should really have what is called diversification. Diversification is an investing concept that investors call it the only free lunch in investing. You want to make sure you're diversified. You don't want all your eggs in one basket. You want enough different types of assets that are not related to each other, so that way, if one of them goes down, other ones might be going up, so it ends up balancing out. It ends up creating a balancing act in your portfolio. A solid financial advisor, solid business coach would have been able to spot that as a whole in Facebook's structure. All of their eggs in one basket. They're putting so much weight on just this Facebook system that if something goes wrong with that system, then suddenly the whole company's down. And that's a really easy thing for an investor to see. And this is one of the reasons why we don't recommend Robinhood. Even if you're buying a lot of different companies in Robinhood, you're buying one company at a time. So you might say, oh, well, I have 20 different companies. That's only 20 companies. There are about 13,000 companies, something like that. Publicly traded companies. There's lots. There's about I want to say 3,000 in the U.S. alone. 3,000 companies, publicly traded companies in the U.S. alone. And you're only invested in 20. You have all of your eggs in just these 20 companies. A better way to do it would be to invest in broadly across the market. Even if you're investing in just the S&P 500, right there, boom, you've got 500 different companies that you're invested in. Diversification. The reason why it ends up working out so well, like I said, as one company might go down, another one's going to go up, and they end up balancing each other out. But you don't want to just diversify with different companies. You also want to diversify with different types of assets. So that might be bonds, that might be real estate, that might be cash. That's actually type of asset. And if a lot of people that I talk to are very afraid of investing because it sounds scary. There's risk involved when you're investing. They don't want to lose money. But if all of your money is just cash, is just money, then you're actually still exposing yourself to risk. You're just exposing yourself to different kinds of risk. So it's important to diversify across asset types. Within those assets, diversify and have different companies, as many different companies as you can. It's important that this diversification ends up protecting you in the long run. A solid financial advisor, if they had seen how Facebook was set up, would have been able to spot that and help them protect themselves better. And a solid financial advisor helping you out, if they're not telling you to diversify broadly, then they're not worth their salt, to be honest. You want to be broadly diversified, and then maybe just slightly tilted with a heavier weight towards the specific types of investments that you want to have. But broadly, you want to have as many different baskets to put your eggs in as possible, and that's going to be what ends up protecting you in the long haul. And that, by protecting yourself, you don't go down as much, which means you got a leg up over everybody when the market kicks off again. So that's what we're going to. That's everything that I wanted to talk about today. Diversification. If you're all in cash, again, that is not diversification. You're actually exposing yourself to all kinds of risk, currency risk, inflation risk, currency risk, for instance. Right now, we're in the first. We constantly hear about the debt ceiling. The debt ceiling needs to be raised, which finally today Congress reached a compromise so the debt ceiling would be raised for just a couple months. But that's a currency risk. If the debt ceiling doesn't get raised, then suddenly the value of the dollar is going to shoot downward. And if all of your money is in cash, if all of your assets are in cash, you're running a very real risk right there. Another risk is inflation risk. We are in a period of high inflation. We were at 5% last time I checked, and that means that each dollar year over year is losing purchasing power by 5%. I don't know if you noticed when you've gone to the store recently, but prices are high right now. The reason they feel high is because inflation has been kicking in a lot of different ways, and because of a lot of different reasons. But inflation is kicking in, and if you have your money just in cash, you're not doing yourselves any favors. So it's important to, again, diversify. Have enough of a cash reserve, but then make sure you're diversifying into other kinds of investments, whether stocks, bonds, real estate. That's it for today. Again, if you want to learn more about investing and diversifying into real estate, come join us for our free webinar at the end of the month. I'm going to put the Eventbrite link into the comments here. Love to have you there. Thank you all so much, and I hope you have a wonderful day, and I'll see you in a couple weeks. Bye.